Good evening, members, and welcome to the third day of the WIRC refresher course on New Income Tax Act 2025. Today is the third day, and the first session will be on concessional corporate taxation and tax controversy. Before we start this session, let us raise for the institute motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you. Members will agree that while doing the corporate taxation, our famous book profit under 100 JB, how we used to calculate, we add certain items, we less certain items under the old Income Tax Act. Now, what are the changes which has gone through in 2025 Act? Let's hear from our speaker, Sneha. I request Nilesh Vasa to briefly introduce him.
Hello. Good evening, friends. Today at BCSE, this is the last seminar, jointly with WRC. So practically second last day of the year, but it's the second last day of the word financial year and assessment year. From 1st April, we have another word that is tax year. So this is the second last day of this word which we are using from 1965. And one more thing, yesterday we had our AGM. Just for your knowledge of our members, our next convener is Aman Khandelwal. So please, Deputy Convener, Aman Khandelwal. Aman, please. He is the next Deputy Convener of BCSE from 1st April. And convener is Sikandar Yadav. He is not there today. So next tax year, Aman and Sikandar will be the convener and deputy convener. Now today on this session, we have a learned speaker, Mr. Sneh Machhar. Sneh sir is a fellow chartered accountant with over a decade of experience in direct tax advisory, currently seeking as a director in the tax knowledge and solutions team at Ernst & Young LLP Mumbai. He has commenced his professional journey with his articleship at C&K and Associates LLP under the guidance of Sri Gautam Nayak. Post-qualification, he joined Ernst & Young LLP, where he worked closely with Sri Pinakinbhai Desai and Srimati Geeta Jani, gaining extensive exposure to complex corporate and financial-led transactions and developing deep expertise in nuanced areas of direct taxations. Over the course of his career, Sneh sir has advised several of India's leading conglomerates, unicorn startups, and global investors across diverse sectors, including banking and financial services, pharmaceuticals, metals, oil and gas, manufacturing, entertainment, hospitality, and real estate. He has had the privilege of being associated with several high-profile transactions in India, including billion-dollar insolvency acquisition, mergers, demergers, succession planning, and family settlement arrangements. Sneh sir is also a regular contributor to the BCAS journal and frequently interacts with senior counsel appearing before the Supreme Courts and various high courts in connection with complex advisory and litigation matters. I would now request our past convener and advisory member, Vijay Jayam sir, to please present a memento of behalf of WRC and BCSE. I would request Sneh sir to please take the charge of the session.
इधर है ये बाजू. डुप्लीकेट कर दो ना. हाँ, I don't. Yeah, so long as people can see it. Thank you for such kind words today. First of all, I would like to thank the Borivali Chartered Accountant CP Study Circle for giving me such a kind opportunity to address the mammoth crowd for me. What is the topic today? It's a simple topic, yet complex. Over the past few years, the corporate tax regime has undergone a severe change. As we saw, from next day onwards, or a day after, we have a new act coming into picture, whereby the 1961 Income Tax Act will be scrapped, and we will have a 2025 Act. Today, I think I have privilege to speak the sections which are in relation to 1961 Act, but in all aspects, the concessional tax regime has remained more or less same, except for the MAT regime which is there on the subject which is there. Now, if we can just see the overview of, what is concessional tax regime. What is it that we have to address today? How did the law come into picture? The first is a case where in September 2019, the government acted swiftly in order to attract investment, in order to make Indian corporates more competitive, to boost the manufacturing sector, to give an impetus of investment within India. This particular bill, or rather ordinance, was passed, and then it got the shape of a bill in the form of bill, and then government acted swiftly, and then we have an act now. The act is in place since previous year 1920, which is there, and today I would not talk much about what is there in the section. Probably every person who is there is learned out here and is much aware about what is there in 115 BAA, 115 BAB, what is there in scope of controversy. That is what I would like to touch upon, so that we all can have some better understanding, we can interact in a better sense, and we have a better outcome today. Now, in summary, I have prepared this slide to just suggest that what the taxpayer has to give up and what he gets. If you see the list of items which are to be given up, like a 10AA deduction, 35AD deduction, incentive link deduction, profit link deductions, all are to be given up. In fact, additional depreciation for the manufacturing company is also to be given up. And what you avail only one thing. One is a smaller tax which is there, and second, you will not have nightmare of computing book profits. That is what you achieve by obtaining an option or exercising an option under 115 BAA. So we move to the controversies which are there on the subjects which are there. Now, I would like to draw your attention to first three controversies which are there. I would like to go little slow out here. First three controversies are highly interlinked. It can arise in a particular taxpayer, one after the other. Okay? So what I've tried to do is set an example which is there, which will be relevant for all three case studies. I would repeat the facts once again, but if you can keep in mind the first scenario which we are dealing with, it will be excellent. Now consider a case where a manufacturing company, not a 115 BAB company, ordinary manufacturing company, let's say it is set up in 2013, okay, it has exercised the option under 115 BAA. So now what will happen? it will have a regime of 22% and effectively 25% of tax rate. It can have, sorry, if you want, sorry. Let's say in year 23-24, previous year, it has exercised the option under section 115BAA. What would happen? It has to give up, though it's a manufacturing company, it has to give up the additional depreciation. Now the first case study focuses on the scenario that if a particular company has exercised an option under 115BAA, can it ever come back to the normal regime? Is it possible to come back under the lower regime, over the old regime, and thereby it can claim the allowances or it can claim the additional depreciation which is there? The area of focus in this particular aspect shall be two provisions of 115BAA. Which are these two provisions? One is first proviso to 115BAA1. Second is a second proviso to 115BAA5. Now if I may just summarize these two provisions which I referred in terms of provisos which are there. What does this proviso tell us? The first and foremost is 115BAA5 proviso which is there. What does it indicate? It says that if a person has exercised an option under 115BAA, it cannot withdraw such option for any assessment year. Okay? So this particular reading of proviso to 115BAA5 tells us that a person who has gone under 115BAA regime can never come out of the 115BAA regime. But this particular proviso of 115BAA5, I think shall not be read in isolation. One has to read 115BAA5 proviso with 115BAA1 proviso. What does 115BAA1 proviso suggests? This particular proviso tells us that if a taxpayer company breaches conditions which are laid down in 115BAA2, and what are these conditions? You give up additional depreciation, you give up income link incentive, you give up profit link incentive, you give up capital expenditure incentive. Then what will happen to you? You will come back to normal regime. Now if we try to reconcile this particular two proviso, it suggests that so long as you are falling within 115BAA2, so if you are fulfilling all the conditions which are listed down in 115BAA2, you can never come out of the regime. But when does 115BAA1 proviso apply? It applies only in a scenario where you breach the conditions under 115BAA2 which is there. Now, why I have taken the example of a manufacturing company is because only the manufacturing company can effectively breach the condition of 115BAA2. 115BAA2 disallowance is additional depreciation. Now, you will ask me a question that why will some company breach the conditions which are there in 115BAA2 so as to go under the old regime? Under the new regime which is there, it is getting the lower tax rate. Under the new regime, it is out of MAT. Now consider a very simple scenario. Consider a case where in FY 25-26, which is the year we are in, the company has supernormal profits. Company does not envisage this particular kind of profits to come in subsequent years. In the 25-26 year itself, the company has purchased extraordinary amount of capital assets which are there. Now, if the assets are being put to use, what can a manufacturing company claim? The simple answer is depreciation and additional depreciation. Now, if a particular company wishes to claim additional depreciation and it works out the income tax liability to be lower than under the new regime, it would like to exercise an option to breach the condition and go under 115BAA, breach the condition of 115BAA and go under the old regime which is there. Now, the way we try to reconcile the provisions is that so long as all conditions of 115BAA are fulfilled, your case is covered by 115BAA in that particular sense, you cannot go out. But once you breach those conditions, you go out and claim the additional depreciation, which you are not allowed to claim. So what a taxpayer has to do in this particular case? While filing the return of income, he claims 115BAA 2 conditions are breached by claiming additional depreciation in its particular return of income. Once those conditions are breached, you are no more under the 115BAA regime. Your old income tax rates which were there resurrects. Your MAT liability also resurrects, and you are under the old regime again. So now, effectively, what we are trying to suggest is that a person who has exercised the option under 115BAA can come out of 115BAA only after breaching the conditions and not otherwise. Now, the question which also comes in mind is that, what if the company is a non-manufacturing company? How can it come out? Is it any particular manner in which a non-manufacturing company can come out of 115BAA? Now, the first question which the professionals which will have to answer is that what benefit are you getting by coming out for a non-manufacturing company from 115BAA regime to a non-115BAA regime? Probably the answer would be that there will be no benefit as such which will be there. And in that circumstance, there is no fun or magic in coming out of 115BAA regime. But if you press me and ask that, how can I come out of 115BAA regime for a non-manufacturing company? And if I have to answer that question, it's a simple thing. I have to claim some deduction under Chapter 6A. Now, what is a Chapter 6A deduction which is available to a company? It's only a political donation which can be done, and you can come out of 115BAA regime. So, in sum and substance, a company which was there under 115BAA regime can come out of 115BAA regime by doing this particular breach of conditions which are there. Now, immediate question, which is the second issue which I wish to address, is that can a company which has breached the condition of 115BAA, can it ever come back to 115BAA? Is it at all possible for a company which has breached the condition can come in 115BAA? The answer to that question particularly lies in 115BAA 1 proviso which is there. Now, if I may go to second issue, and if everyone can see the first particular box which is there, I have tried to, extract the particular sentence from the provisos which are there. And for the benefit of all, I'll try to read the proviso which is there. It says that provided where the person fails to satisfy conditions in 115BAA 2 in any previous year, the option shall become invalid in respect of the assessment year relevant to the previous year and subsequent assessment years, and other provisions of ITA, Income Tax Act, shall apply as if option had not been exercised for the assessment year relevant to the previous year and subsequent assessment years. Now, some controversy here can arise because of the using of the word as if. It says as if the option had not been exercised for the assessment year relevant to the previous year and subsequent assessment year. It deems that you have never exercised an option. So, in year 1, I am under 115BAA regime. In year 3, I breach the conditions of 115BAA. When I come to year 4, can someone really argue that, because the words which have been used are as if, it is deemed that you have never exercised an option, can someone say that your provisions itself are saying that you have never exercised an option? Can I again come back and exercise an option by filing 10 IC form and suggest that, okay, I re-exercise my option? Is it a possibility? Now, if this becomes a possibility, then it is a flip-flop every year. The year in which I want something, I'll breach the condition. In year in which I want 115BAA, I'll exercise the option under 115BAA. Because option is as if it is not exercised. Now, that does not seem to be the legislative intent. It's, if you read the proviso very closely, it says that the option shall become invalid in respect of the assessment year relevant to the previous year and subsequent assessment years, and other provisions shall apply as if you had not exercised an option. So the words which have been used, which are deeming provision as if the option was never exercised, it is not used in the context of exercising the option, but it is used in the context of what will be the effect of breaching of condition. It says that option shall become invalid and other provisions apply as if you had not exercised an option. So, as if word is used as an outcome. What will be the outcome once you breach the conditions which are there under 115BAA? It does not suggest that you can flip-flop every year. You can have 115BAA regime at your discretion and you can come out of it at your discretion. So, once under 115BAA regime, what we saw so far, once under 115BAA regime, you have to stay under 115BAA regime unless you breach the condition. You breach the condition once, you are out of 115BAA regime forever. It's the proviso which is there, the first proviso gives an outcome, that what will be your outcome once you are out of 115BAA. So in that particular case, what will happen? You will come back to normal provision. Your MAT provisions also resurrect. It will come back to life and you will have to pay the taxes which are there. Now, before I move to next case study, one particular aspect should be noted by the professionals. Now, under the Finance Act each year, we say domestic company rates which are there, right? Domestic company covered by 115BAA one tax regime, domestic company not covered by 115BAA other regime, which is 30% tax which is there. In the middle, each Finance Act particularly provides for a turnover-based criteria companies which are there, which is a 400 crore turnover which we have. Let's say a company which is there for tax year 25-26, it can still, even if it is not there under 115BAA regime, it can have a tax rate of 25% plus surcharge plus cess, because the Finance Act of each year, Part E of Finance Act of each year, provides that particular tax rate if your turnover does not cross. So, in case of your client, where you have breached the condition under 115BAA, but the turnover of the client for 23-24, if you are computing the tax liability for 25-26, you have to see the turnover of 23-24, and if it does not exceed 400 crore, even if it is not a 115BAA company, still it can claim a 25% rate as increased by surcharge and cess. So it doesn't mean that once you breach 115BAA, you are always under 30% regime. You can still come under 25% regime plus surcharge plus cess. The highest tax comes to around 29.12%, still lower than 30% of tax which is there. Now, since we are chartered accountants, we are a bit inventive in nature. Now, let's take an example. We are continuing the first example. In tax year 23-24, the company went into 115BAA regime. 25-26, it has breached the condition. We saw that once you have breached the condition, you cannot claim 115BAA again. Yes, sir. Yes, sir. It is a controversy which will come. I think issue number 6 or 7, I have kept it. Particularly, I have kept it, and it will arise in the controversy of Finance Act 2026 amendment which have come. That issue also I have kept. If you can just wait for a while, that particular provision I have kept, and I'll come to that in few minutes. Now, I'll just repeat the example which you are trying to take. In 25-26, previous year 25-26, the conditions are being breached under 115 BAA. Now, is there any chance by which this particular company can come under 115 BAA again? If the company were to survive on its own, if taxpayer company who has breached the condition were to survive on its own, in my view, humble view, the answer may be no, it cannot come. But are there ways and means by which some corporate reorganization, some corporate organization which can be done such that the answer is different? Now consider a case that group has two companies, ACO and BICO. ACO has done what we just described, went into 115 BAA, breached 115 BAA. BICO may be a company which has not exercised the option, or it is already there under 115 BAA regime. What will happen in that particular context? Now, let's take a simple example that a company which has exercised the breach conditions which are there under 115 BAA merges into a company which has exercised the option under 115 BAA. So, in our example, what happens? ACO merges into BICO. BICO is an entity which has either exercised 115 BAA or it is eligible to exercise 115 BAA. Now, first of all, we have to answer a question that is 115 BAA a provision which is linked to taxpayer, or 115 BAA is a provision which is linked to an undertaking? In past, we have several examples like 10AA, ATIA, ATIB, 10AB, 10B, etc. All those examples which are there a particular provision, the deduction was linked to undertaking. It was not linked to a person. So let's take a simple example that where ATIA undertaking were to move from ACO to BICO, for example, ACO will not be able to claim ATIA, but BICO will be able to claim ATIA because it was linked to undertaking and not linked to a particular person. Once we have that particular clarity as regards 115 BAA, we can see the consequences. Now, if we see the section 115 BAA 1, which is there, it suggests that it is linked to a person being a domestic company. It is not linked to any business. It does not talk about undertaking. It says that it is linked to a person. Person means a company, company means a domestic company. Now, if ACO had breached the condition, ACO merges into BICO, BICO has exercised the option under 115 BAA, what will be the outcome? From the appointed date of the amalgamation, all the profits, losses, whatever are there of amalgamating company will become profits, losses, all that of amalgamated company. Now, let's say ACO and BICO files a scheme of merger from 1st April 2026 only. First day of the tax year 26-27, and it merges into that entity. Can BICO exercise? It has already exercised the option under 115 BAA. Once business of ACO becomes part of BICO, then ACO comes to an end. We have rulings from Saraswati Industrial which says that ACO which is there comes to an end from the appointed date once the scheme has been approved. Now, BICO, which has exercised the option under 115 BAA, can continuously claim that particular lower rate of 22%, and it can also say that I will not pay any tax under 115 BAA, I will not pay any tax under MAT, and I will claim a 22% regime for the tax liability. Now, is there any other mode by which this particular thing can be achieved? One is a mode which is merger, which we saw. Demerger of an undertaking may also give a similar result to you if you do a demerger, which is there. And the last idea can be slump sale. Slump sale gives taxability. It is not a neutral transaction like merger and demerger. On merger and demerger, we have neutrality provisions from the perspective of transferor, transferee, shareholders of the transferor, all. But in slum sale, we don't have neutrality provision. And after insertion of Rule 11 UAE, which is providing the deemed consideration provision to you, you need to pay tax. Now in that case, is there any option without going to NCLT? Because merger, demerger with both involve going to NCLT. Is it possible that, let's say ECO establishes another company as a WOS, wholly owned subsidiary, and transfers a particular undertaking to a wholly owned subsidiary? What happens in that case? The undertaking goes to a wholly owned subsidiary, which is a different taxpayer as compared to ECO. It can go under 115BAA regime. And why a WOS to be found? Because of the 47(4) exemption. Without that, if you transfer by way of a slum sale, you will have a tax liability under 50B Rule 11 UAE. Now, the entire gamut of issue 1, 2 and 3, does it suggest that you have open powers available with you as a taxpayer to plan the manner in which you want? Or is it that someone will invoke GAR in this particular scenarios? Now, if it is purely done, breach of conditions, followed by amalgamation, followed by demerger, followed by slum sale, all with an intent to reduce the tax liability only, without the commerciality involved in the process, then the GAR is bound to hit you. So standing here, I am not encouraging anyone to breach the conditions, do things which are not envisaged under GAR and claim lower tax regime. But in a case where some taxpayer has breached the conditions inadvertently, some taxpayer wants to go back to the old regime, this is the manner in which you can definitely go under the old regime, even after breaching the conditions which are there. So this was that's why I suggested that controversy 1, controversy 2 and controversy 3 are so interlinked that we have to keep in mind the facts of the case which are there. Now, controversy 4 and 5 which are there, yes. It's okay. Oh, okay, fine. I'll hold, no worries. आप कीजिए, आराम से कीजिए. Thank you so much. I can go. Next two issues which are there, issue number 4 and issue number 5 which are there, are somewhat in relation to conditions which have been laid down in the 115BAA2. The prime conditions which are there under 115BAA2 the two conditions which I have dealt with here so far is, one is suggestive that you cannot claim deduction under 35AD, you cannot claim deduction under 10AA. There is a second condition which suggests that taxpayer company cannot set off any loss carried forward or depreciation from any earlier assessment year if such loss or depreciation is attributable to, in our example, attributable to 35AD or 10AA. So, in a case where there is a loss which is attributable to 35AD, or if it is attributable to 10AA, I cannot claim that particular aspect. Okay. So, if you see on the left hand side which is there, I have taken a very simple scenario where revenue of the company is, let's say, 2,500 rupees. Revenue expenditure which it has claimed during the year is 1,500 rupees. 35AD capital expenditure which has been claimed is to the tune of 1,000 rupees. Because of the mathematical calculation, we arrive at a loss of 400 rupees. In this particular case, the taxpayer is claiming deduction under 35AD. Now let's say this particular taxpayer claimed in previous year 24-25 this particular aspect and filed the return of income in this particular fashion. So it is not under 115BAA regime, very clear, because it has claimed the deduction under 35AD which is there. Now let year 25-26 come, and for some or the other reason taxpayer wants to go under 115BAA regime. The question which is to be asked is that whether this particular 400 rupees of loss which is there, whether it is to be given up. Because I am coming under 115BAA regime now. Now the question which is to be asked in this particular case is that, is it loss carried forward which is attributable to 35AD? That's the question to be asked. If I fall within those 5-7 words which are there, I am not allowed to carry it forward. Now, what is essentially 35AD? 35AD provides for certain types of business, say semiconductor wafers, slurry, cross-country pipeline, etc., all the hotels, etc., which is there. For that particular aspect, I am allowed a specified expenditure, which is capital expenditure, which is not otherwise allowed to me. Otherwise, for capital expenditure, I am only allowed depreciation for it, not entire deduction of the value of the capital expenditure which is there. Now, a particular business which is there in the 35AD is referred to as a specified business. Now, one has to really ask a question that whether when a particular person is claiming 35AD and there is a loss, is the person carrying forward the loss under 35AD or is the person carrying the loss under 73A? Because 73A is the provision which allows me to carry forward the losses which are there. Now, if we read 73A, it suggests that it does not differentiate between the capital expenditure and revenue expenditure. It says that loss from a specified business. Now, if we see in this particular light, this particular example, is my loss carried forward under 35AD? Is my loss only attributable to 35AD? The answer to this particular question, in my humble view, may be no. Why? 2 or 3 reasons. One, 115BAA2 does not say that you cannot carry forward losses of specified business. It says losses cannot carried forward attributable to 35 AD cannot be carried forward. Now, if my loss is carried forward under 73A, it is not under 35 AD. Second, if you see this particular example, and I've tried to make it, if you play with the numbers a little, we are well aware about the principle which we apply in the context of 14A, which we apply in the context of 3613. That is beneficial allocation theory, right? In this particular case, see the revenue of the taxpayer. It is standing at 2500 rupees. If the tax authority were to tell me that because of 35 AD your loss is there, my answer could be different also. My answer could be that my loss, particularly my revenue, first should be set off against the 35 AD expenditure. In that particular case, the loss of 400 which is there is applicable to revenue expenditure. It is not applicable to 35 AD particular loss which is there. Now, if that view be right, and that beneficial allocation theory, which we have used time and again, and which has been blessed by the Supreme Court as well, then in this particular example, 35 AD expenditure loss is not attributable to 35 AD alone. It is attributable to revenue expenditure. Here, I think the senior members who are present may also recollect the circular which was been issued, I think in 1955, which suggests that where losses are to be adjusted by the taxpayer, then the choice of adjustment of losses which are there shall be at the discretion of the taxpayer and not the tax authority. Now, if I invoke that particular circular in this particular context, again, my answer will be that 35 AD expenditure is fully consumed by the revenue. What is left is only that part of revenue expenditure which is yet to be absorbed. Now, if the taxpayer were to claim in FY 25-26 or tax year 25-26 a 115BAA regime, then in that context, the answer can be that 35 AD expenditure is fully consumed, nothing is left, 400 of the loss which is there shall continue, and there shall not be lapse of any loss. Now, this particular view which I am trying to express, it's an untested proposition, not been tested. The beneficial allocation theory is tested proposition, but in the context of 115BAA, we do not have any precedent yet on this subject so far. Similar example which is there is I have tried to capture for 10AA. Now, let's say a unit which is there is still having a 10AA unit. There can be units which still can have 10AA. Now, let's take an example that it is an information technology export unit which was there, and it was exporting the services. Disruption is there since last 2 years in IT sector. 10AA unit incurred massive losses which are there. I am yet not under 115BAA regime. Now, overall basis the taxpayer has a profit, but from a 10AA unit he is incurring losses. Now, in this particular example, the 10AA unit is incurring the losses. Let's say the losses are incurred for tax year 24-25. Again, the same example to be continued. In tax year 25-26, can it go under 115BAA regime? Answer is yes, it can go. But whether the losses which are there of 10AA unit, can it continue? Now, what does, again, if we read the section 115BAA2, what does it say? It says that without set off of any loss or carry forward, losses carry forward or depreciation from any earlier assessment year, if such loss or depreciation is attributable to deduction under 10AA. Right? In our example, we are talking about 10AA unit. Now, what is 10AA? 10AA provides a deduction. When does 10AA come into picture? It comes into picture when you have profits. The government does not pay you back when you have losses. It says that you cannot claim. There is a specific embargo which suggests that if you have losses, you cannot claim. Now, 10AA unit which has incurred the loss which is there, is it attributable to, loss is attributable to 10AA? Is it because of claim of 10AA that loss is generated? Possibly the answer is no. Losses cannot generate because of the deduction. There is an express embargo under the provision which says that you cannot have a losses which are there. You cannot claim deduction when you have losses. If that be the case, in that context, in previous year 25-26 or tax year 25-26, when a person moves from old regime to new regime, in my view, the loss which was incurred by a 10AA unit shall not be required to be given up, is not required to be given up. It can claim even if it is under 115BAA regime. That's the view which has that particular view which is there is expressed by myself. Now, take a simple example that where you have depreciation loss which is there. Depreciation which you have claimed, and that depreciation has remained unabsorbed. Your additional depreciation amount which is there has remained unabsorbed. That particular circumstance I can agree with you because it is directly relatable to that particular expense. There are a lot of circumstances like site restoration fund. We don't see often that particular provision of site restoration fund. But you can claim deduction of contribution made. So if it gives you a deduction whereby it suggests that you contribute to a particular bank account which has been maintained in accordance with the scheme, then you get the deduction under site restoration fund under 33B which is there. Now if the loss which is there is purely on account of that particular contribution which is there, then yes, my answer would be yes, that has to be given up immediately. But because we are going by the strict reading of the law which is there, can ever a loss arise because of the claim of deduction? Or in our example, you have not claimed the deduction at all. You have not claimed the deduction at all. Is it because you are barred from claiming the loss? Still the revenue can suggest, in my humble view, answer may be no, you cannot. Because I have never claimed the benefit of 10AA in respect of that particular loss amount, then how can you tell me that you set off that you give up that particular loss which is there? Sorry? Yes. It says that, I'll read it for you, sir. It says that without set off of any loss carried forward or depreciation from any earlier assessment year, if loss or depreciable is attributable to deduction referred to in clause 1. So it says that loss or depreciation if attributable to 35 AD. Correct. Correct. Yes. Yes. No, so if it is a case where your particular loss which is arisen, it does not, there are two arguments to it, and we may have a different of view in that. It does not say that loss attributable to 35 AD. In my particular example which I have tried to carve out, beneficial allocation theory is there, and second answer is that it is that loss attribution right is to the taxpayer, not to the tax authority. Specified business, but mine is a case where if you see the example, and I'll come back to the example which is there. Here, can I not argue that in this particular case, the losses which are there of 35 AD which is there, I have claimed 35 AD, I agree with you, but can I not urge or argue that it is already been absorbed? 73A says, it does not say loss carried forward under 73A. It says loss attributable to 35 AD. In this particular case, sir, Humbly, 3580 is already consumed. It is already been consumed. What is left is revenue. Had it been a language, their loss cannot be carried forward of a specified business, then I would have agreed with you. But it does not say in so many words. It is just saying that it is attributable to 3580. That is the line of distinction I think I am trying to draw, sir, in that particular aspect. Now, issue number 6 which is there, probably it's the issue which is there is more of a procedural in nature, but important to know. How you exercise the option under 115BAA? You have to file Form 10IC, and the language of 115BAA 5 suggests that it is to be done before the date of filing original return of income. So 139(1) comparable to 263(1) now under the new act. New act also uses the same terminology which is there. Now, there have been cases in the past, decided cases in the past, where a particular taxpayer has filed the return of income, let's say under 139(1) itself. Maybe because of some mistake on the part of accountant doing the procedural part, he has not filed Form 10IC. He has missed Form 10IC to be filed. And that Form 10IC which is there is filed but belated filed. In that context, can tax authority deny the benefit of 115BAA? The people may feel that why such big issue out of it? The only thing which we have to keep in mind is the decision of Wipro here. In case of decision of a Wipro, it was dealing with a case of 10B. Okay? Very interesting case. In that particular case, the taxpayer had a 10B unit which had incurred the losses which are there. Now, taxpayer filed a return saying that I want to claim 10B. So what will happen? Because at that point of time, 10B was an exemption provision, not a deduction provision. Now, your loss from the exempt source will not be allowed to be carried forward. It cannot be carried forward because profits cannot be taxed, losses cannot be carried forward for an exempt unit. During the course of assessment, taxpayer realized that I have done a wrong exercise of option. I should not have said that I want to claim the exemption. Rather, I should say that I don't want to claim the exemption at all. Now 10B8 is a particular provision which suggests that if you want to get out of 10B, it itself, the section itself provides an option that if you want to go out of 10B8, what do you need to do? It says that you have to file a declaration with the assessing officer prior to filing of return of income under 139(1). In case of Wipro, it filed the return of income. See this. It filed the return of income. Did not say that I want to come out of it. Okay? And during the assessment, it filed a letter saying that I want to come out of it. What was the argument of taxpayer before the Supreme Court? Taxpayer argued very simply that this is procedural in nature. Being procedural in nature, you cannot say if I have missed the bus. So that means that you should allow me the losses which are there, and my exercise is a valid exercise even though I have done at the time of assessment. That was the precise argument which was being made before the Supreme Court. What did Supreme Court suggest? Supreme Court in case of Wipro suggested that when a particular process has been laid down under the Act, it has to be followed in that particular methodology to the teeth. If I don't follow that particular measure, then in case of Wipro, Supreme Court has not allowed the carry forward of losses. It says losses have lapsed because you have not done what was required under the law itself. Now, come to 115BAA. With this Wipro judgment in mind, come to 115BAA. What does my section suggest? It suggests that option is required to be exercised and Form 10IC which is there is to be filed before 139(1). Now, there have been decided cases which are there in this particular aspect that whether this particular case where a taxpayer has filed the return of income on time, okay, but has failed to file 10IC, what is the outcome? Fortunately, so far, the High Court's judgment which are there in case of Rama Industries, VRG Electronics, Cellcom Teleservices, Camino Herbal Remedies, all these High Court rulings have distinguished Wipro judgment. How it has distinguished? It has suggested that in case of Wipro, the taxpayer did try to do flip-flop. It has, first, while filing the return of income, it suggests that I want to claim 10B. Then it says that during the assessment, I want to go out of that. Rather, in the cases which are being decided by the court so far, taxpayer filed 115BAA return of income itself. In the return of income it has said, I have exercised an option. But Form 10IC was not filed. That particular aspect is still considered to be procedural by High Court rulings which are being there on the subject. Whether it will go to Supreme Court, I don't know. But Wipro ruling has to be kept in mind where there is a delay which is there in particular aspect. In this particular circumstance only, the second scenario can be, what if I file a return of income which itself is delayed? Rather than filing under 139(1), I file delayed return of income, which is there. Can I still claim 115BAA regime to be proper regime? The answer to that particular question, in my view, should be negative, because you have neither filed return on time, nor you have filed 10IC on time. Applying Wipro in that particular context, you may not be able to claim. However, there are two tribunal judgments which are there on this particular aspect, which have said that the provision of 115BAA5 does not expressly bar the taxpayer from filing 139(4) return of income and claim. In my view, those are stray judgments which are there to be used only in the context of litigation and shall not be done on a day-to-day basis when professional is advising the client. A particular very good example came in the form of Delhi High Court judgment. In case of Sarla Fibers, Sarla Textile Fibers, which is the name of the judgment. In that particular case, taxpayer suggested that in the return of income filed, which was there, it said that I don't want to claim 115BAA. I want to continue by MAT regime. Suddenly, after few months, it realized that no, now I want to claim 115BAA. By the time intimation had already come. Now against that intimation, taxpayer filed an appeal. It went up to Delhi High Court. The matter went up to Delhi High Court. Delhi High Court suggested that you never exercised the option of 115BAA. You never filed Form 10IC. Your return of income is suggesting that you are still under the old regime. Then by filing a letter or by claiming that there was a mistake on the part of the accountant, you cannot come under 115BAA regime. That particular case went in SLP before Supreme Court. Supreme Court has rejected the SLP in limine. So this shows that if you don't exercise the option in a particular manner provided under the law, it may be difficult to suggest during the assessment proceedings that I want to exercise. So chartered accountants who are advising clients shall be very careful in this simple procedural aspect as well, which may be kept in mind always. Now, one particular aspect which I want to cover, 115BAA, which is there, is corresponding to section 200 under the new act, which is there. Under the new act also, 200 subsection 5 suggests the same language. It carries the same language as it is carried under 115BAA5. If you go and see the rules which are being notified, it suggests that option which is there has to be filed in the return of income itself. There is no separate form which has been notified similar to 10IC. Probably the form itself, though we don't have the income tax form, return form which have come, probably the return of income itself would carry the reference that whether you want to exercise 115BAA5 or no. Now, if you see this particular aspect, it becomes more important. Now you have only one particular thing to be exercised in the return of income itself. And if you don't file within the 200 subsection 5 that particular return of income before the due date of return of income, I think the bus would have been missed and you may not be able to claim, subject to litigation up to the level of Supreme Court if you want to go. Now, yeah. So, since you have asked this question which is there, that particular aspect is covered by the transition provision. This is small, I will cover here itself because he has raised a question. If you see transition provisions which are being notified under 536 section, there is a 536 subsection 2 clause F which suggests that any particular election or declaration made or option exercised by an assessee under any provision of the repealed Income Tax Act, which is 1961 Income Tax Act, shall be deemed to have been an election or declaration made or option exercised under corresponding provision of the Act. So, the transition provision carries a deeming fiction that once you have exercised an option under 115BAA5, it's a deemed option which you have exercised under section 200 subsection 5 and you need not exercise. In fact, there is a 99-page FAQ which has come on the income tax website. Kar Sathi, that's the heading which they have given to the entire manual. It carries a specific section which suggests that you need not exercise the option. It is specifically mentioning 536 2F as a section and you need not exercise. If you have to say you have already opted in the return of income. I don't know what forms will be notified, what it will carry, but if it is something new, then we have to see that particular aspect before we exercise an option. Now, this particular aspect, IFSC or gift city, this is gaining a lot of eyes of many of the taxpayers. It's like, in my view, it's like creation of a second Mauritius, where every activity which is there is exempt, or every activity for which some or the other deduction is available to you. Now, there can be cases where a domestic taxpayer may also go in here. Let's say you have a particular taxpayer who is providing fund services. So it provides services for management of funds. And it establishes a unit or a company within the gift city. Now, if you see section 115BAA2, it says that you can claim, even if you are under a new regime, you can claim 80JJAA, which is employment linked deduction, which is there. You can claim ATM, which is there, which is rollover benefit. Some of us do miss to go to 115BAA4. Though it is not mentioned in 115BAA2, if you go and see 115BAA4, it suggests that even if you are claiming 80LA deduction, still you can be governed by new regime. So, apart from claiming 80JJAA, 80M, you can still claim 80LA. So, you have a tax holiday. So, in my example, if I take it forward, it suggests that a fund manager, let's say it establishes fresh unit in IFSC in the year 2026-27. Okay? That is my first year. What does 80LA tell me? And why it is so relevant? 80LA gives a deduction to a taxpayer of entire 100% of the profits for 20 years out of 25 years. It's an option which is given to me that for 20 years out of the 25 years in which I have been given an approval, I can claim full tax holiday. No tax to be paid. Now, consider a case where this particular taxpayer who is providing professional services to me has gone to IFSC. It feels that for first 5 years, I will have limited operations, but subsequent 20 years, I'll have tremendous amount of operations, and it will be better off for me to claim the deduction from 31, 32 onwards, rather than claiming from 26, 27 onwards. Now, what will happen for those 5 years which are there? 26, 27 up to 31, 32, what will happen? What tax rate would apply? Once I told you that there is a 115BAA regime which you can exercise. Second aspect which has to be kept in mind by all professionals is that there is something known as section 218 of the New Income Tax Act. This particular section has been placed in the New Income Tax Act by Finance Act 2026. So it's a freshly enacted provision under the new act which is there. It was not there at the time when the bill stage which was there. It was not there when it made the act, but it has a specific amendment which has been made to an act just now by way of Finance Act 2026. What does 218 tell us? It says that if your nature of income is covered by ATLA, you are not covered by ATLA, because for first 5 years you are not claiming ATLA. But if your nature of income is covered by ATLA in particular, then the tax rate is 15%, flat. 15% plus surcharge plus cess. So even if you are a domestic company, earning income which is specified under ATLA, you are not claiming ATLA by any means for first 5 years, your tax rate is limited to 15% only. But which income? Those income which is specified under ATLA. Now question would arise, what about income which is not specified under ATLA? Let's say I earn a bank interest. There is a FD which has been made and bank interest is earned before the funds are deployed. That income is not covered by ATLA. What will happen? Because 115BAA allows you to claim to be under the old regime, your rate will not be 30%, your rate will be 22% plus surcharge plus cess. So on the income which is there, which is specified under ATLA, your rate would be 15%. Non-specified income under ATLA for first 5 years, your rate would be only 22%, because even if you are under 115BAA regime, you can still opt for ATLA. What will, the next question will be, what will happen after 51, 52 when the entire thing ends? After the tax holiday period of 20 years ends, what will happen? 218 provision is engrafted under the Income Tax Act forever. So long as you are doing the activity which is specified under ATLA which is there, your income tax rate will forever be 15%. So in a way, what does 218 suggest? 115BAB gave 15% to manufacturing company only. Gift City does not cover any manufacturing activity. It covers only service sector. So if you are providing services through the Gift City unit, which is there, first you enjoy ATLA for 20 years. Then you continue to be charged under 15% rate. So effectively, manufacturing and service, but service only where service center is located in IFSC and earning income which is specified under ATLA, which is there, you will have 15% rate forever. This has to be kept in mind because there can be a lot of planning which can be done around this by a lot of taxpayers who are providing services through Gift City. Now, the question which Sir raised, what will happen for MAT credits which are there? In this particular aspect, 2 questions may arise. So, one particular question is that if, forget about Finance Act 2026, if we keep aside Finance Act 2026 and if we again go back to example number 1 from which I started, it says that you have breached the condition under 115BAA. You came back to normal regime. Can you claim MAT credit which was lapsed earlier? Because once you claim under 115BAA, your MAT provision cannot apply. Now the answer is not very easy to this particular question in my view. What we have to see is 2 provisions in my view. One is 115JB subsection 5 and one is 115JAA subsection 8. What does 115JB5 tells me? It says that provisions of section 115JB shall not apply if a person has exercised the option under 115BAA. So once you exercise the option under 115BAA, book profits are not applicable to you. Simple words. What does 115JAA tells me? It says that a person who has exercised the option under 115BAA, to this particular taxpayer, this provision shall not apply. Right? It says that provision shall not apply to that person of MAT credit. Now, in a case where a taxpayer who comes back to the old regime, can he suggest that my MAT credit which was gone can resurrect back? Now, there are arguments in favor and arguments in against. Both arguments are there. If I have to narrate the arguments which are in favor, then the arguments go something like this. 115JAA5 suggests that this provision shall not apply. 115JAA5 never suggests that the MAT credit which is not utilized lapses. It doesn't use that word. It does not use the word that MAT credit is given effect to. This is unlike 115BAA. If you see provision of 115BAA on a very close basis, it says that the loss or so once you have some losses which are carried forward or losses depreciation which is carried forward which is there, then 115BAA3 specifically says that the loss or depreciation referred to in 2 and 3 of subsection 2. So subsection 2 says that you cannot claim any losses which are there. Subsection 3 is specifically inserted, suggests that the loss and depreciation referred to in subsection 2 shall be deemed to have been given effect to and no further deduction shall be allowed. These particular words are being used under 115BAA3. It says that losses are full given effect to. Does 115JAA use that language? My answer is no. It does not say that this particular MAT credit has been fully given effect to. It does not use that particular phraseology. Second argument. Unlike the carry forward provisions which are there under the carry forward of losses or unabsorbed depreciation, they are to be checked on a year-on-year basis. They are to be examined on a year-on-year basis. Let's take an example where there is a change in the shareholding, 79 year losses may lapse. It cannot revive. So those particular aspects are determined on a year-on-year basis. MAT credit is not like that. MAT credit only comes into picture when you have a payability under the normal provision of this act and you have a MAT credit. Now once your payability comes under the normal provision of this act, 115JAA also should resurrect to suggest that those credit which was not available earlier now comes back to me, because provision does not say that it has given effect to. Nor does the provision say that I have to give a year-on-year effect to a particular provision. So if we go on that particular line of argument which is there, that particular line of argument suggests that it is resurrected, it is allowable, even for companies which have breached the condition, you should come back to normal regime. And once you are under normal regime and you are paying under the normal provision, not paying under the book profit, the MAT credit should be allowed to you. That is particular view one which can be developed. What could be the counter, or what could be the arguments which tax officer or a tax authority may gather? Tax authority may suggest that once you are out of 115JB regime, once the provisions are not applicable to you in a particular year, that means you are never to be governed by that regime anymore in the further years. Just like your carry forward of losses, just like your MAT credit, just like your carry forward of losses, MAT credit also is to be examined on year. Let's say in 23-24 you exercised an option. Okay? 24-25 also you are under the new regime which is there. You have exercised the option under 115BAA. Now, in FY 24-25, when still you are under the old regime, in that particular case, do you compute your MAT? Or MAT is given a go-by? Tax authority may suggest that MAT is given a complete go-by in 23-24, 23-24 as well as 24-25. Now if MAT is given a complete go-by and 115JAA suggests that this particular provision is not applicable once you have exercised an option, it shall not be available to you. And 115JAA 5 says that once you have exercised the option, if I have to read the provision, it says that the provision of this section shall not apply to a person who has exercised the option. Tax authority will say that you have exercised the option once. It's not like that you have never exercised an option. Once you have exercised the option, you are not governed by 115JAA anymore. So that can be the arguments against that particular provision which is there, and those arguments will come for the taxpayers who are going to go under Finance Act 2026 also. Same controversy would apply. I'll try to cover, if it is possible, I'll cover that particular aspect also in the latest slide. Hope I have answered your question, sir. Now, transition provision, I just did that, mention that particular aspect. One interesting issue, 115BAB which is there, people say it has become now a stale provision because whoever has exercised the option during up to March 24 has exercised the option, and those companies who have exercised the option will only be governed by 115BAA. No fresh companies can go. If there was a proposal which was being floated by the FICCI and BCAS, etc., that even ICAI, that you extend this particular regime for further years which are there. That has been categorically denied by the Finance Minister and Revenue Secretary both, that it was a window which was there for a particular period and we are not going to extend it any further. Now, can controversies arise under 115BAB also? Now, consider a simple case that for tax year 21-22, taxpayer established a unit for manufacturing pencil or pen. Okay? It is manufacturing? Answer is yes, it is manufacturing, it is qualifying in nature. All the income which has been earned from the manufacturing is taxed at 15% plus surcharge plus cess, which is there, 17%. Now let's say in year 25-26, that particular taxpayer wants to go for a expansion. Now, what kind of expansion we can think of? It can be anything. It can be continuing line of pencil. It can be procuring wood, making pencils. It can be additional line, say I want to manufacture pen now. It can be additional line that I want to manufacture a rubber now. So it's the same line of business which I want to continue. Or it can be different line of business. Let's say I want to establish a chemical unit. In that particular company itself, I want to now establish a chemical unit. Now, that is also a manufacturing activity. Undeniably, it's a manufacturing activity, making of chemicals. Now, can that particular unit still continue to claim 115BAB? I expand manifold. My expansion comes only after 24. March 24 has gone. If you read the provision very carefully, again, 115BAB, just like 115BAA, is a person-linked incentive. It is not a business-linked incentive, which has been there. Now, if it's a person-linked incentive which is there, then if I keep on expanding in the unit, the answer may be favorable, that nothing is to be done in this particular aspect. Everything which has been established by the taxpayer as a new particular unit shall be available for the 15% rate which is there. Now, can tax authority take an argument that what was the intent of the provision? Intent of the provision was to boost the investment in manufacturing sector. did you really make investment up to 31st March 24? Can you really claim the benefit of investment which has been made subsequently? Are you within the spirit of the law of 115 BAB, or that spirit is to be given up and only the language of the provision is to be seen? The technical answer in my view could be that there is no condition which has been laid down in the 115 BAB which says that you have to make investment in particular unit, you have to make investment in manufacturing unit by this date. So long as you are making an investment and it is a manufacturing activity, a person should be eligible to claim that lower tax regime even in respect of expanded business which is there. Now that controversy may be faced by many of the taxpayers if the units are to be expanded with new line of business, horizontal, vertical integration, whatever you want to do, that question may come. Now sir, do we have another 5 minutes, or do we have 5 minutes? So I'll now what has come by way of Finance Act 2026 in terms of the MAT regime which is there? Simple provisions. MAT has been reduced to 14% from 15%. MAT credit has been totally abolished. You will now no more, even if you pay under the MAT, you will not get the benefit of MAT credit anymore. Third, what about the past MAT credit specifically dealt by them? We will deal with that. And what is the carry forward period? 15 years. That is not a controversial point. Now, MAT credit which they have abolished, what will happen? Let's say a taxpayer which has a 10AA unit which is there, will continue to claim 10AA. He doesn't want to go under 115 BAA. If he goes under 115 BAA, he has to pay tax at 22%. Now if a taxpayer has only single unit, which is 10AA unit, he may like to continue to claim 10AA and pay MAT at 14%. But he will not get any of the credit which is there. Future. So your MAT credit MAT liability which is there, computed at the rate of 14%, becomes the final tax liability. It will no more be advanced tax. MAT was previously considered to be advanced tax because I'll come out of MAT someday, I'll pay under normal and I'll claim the benefit of MAT credit. So MAT credit is no more advanced tax, it becomes a final tax liability. Now, taxpayers who are having multi-units, let's say it has units which are there in 10AA also, it has units which are there under normal DTA area also. It has to run the mathematical consequence, because if it goes under 115 BAA now, what will be the effect? And if it does not go, what will be the effect? That has to be measured particularly because MAT credit is gone. Now, what issues can arise about the past MAT credits which are there? One interesting issue which has come to my mind. Yes. Huh. Yes. Yes. So it is, the provision is worded in this particular fashion. So you have a case law of Nagarjuna fertilizer, which is an old case law, Andhra Pradesh High Court. If a particular item is making a difference, it was I don't recollect the exact facts of the case, but in that case, because of a depreciation, I think there was a difference between the normal tax and MAT, and that the court suggested it amounts to double taxation, you should avoid that. That is a case which is there in favor, but does not fit within the language of the law, in my view, in particular. There are stray cases which have held. Nagarjuna fertilizer is one of the example. But if you really think, if you try to fit within the language of law, you will not be able to fit in that particular fashion. You can argue that is argument is possible, very much possible on the part of the taxpayer. One particular provision that has come to my mind is that first I'll tell you how the MAT credit is to be utilized. MAT credit is to be utilized only in a case where you are a company which is going under new regime. So if you have a MAT credit today, let's say FY 25-26, up to that day you have MAT credit. You don't go under 115 BAA regime at all. Can you claim MAT credit? The answer is no. Because the provisions are being worded in such a manner that only in a case where a company goes under 115 BAA or corresponding provision of 200 under the new act, it can claim the MAT credit. Before that you can't claim. How the MAT credit shall be claimed? Let's take a simple example that for year 23-24 you have 1000 rupees of MAT credit. For 24-25 also you have 1000 rupees of credit, and 25-26 also you have 1000 rupees of credit. Now in 26-27 you exercised 115 BAA. Because you exercised 115 BAA, now you can claim the MAT credit. The question arises is that it says that such credit brought forward shall be allowed to be set off in any tax year to the extent of 25% of the tax payable on the total income computed as per the provision of this act. It says 25% of the tax payable on the total income. Now 25% of what? 25% of the total income of this year, that is correct. But will you allow 25% for all 3 years? Or a combined, so in our case, individually, you have 1000, 1000 and 1000. Right? Your tax liability, let's say for the year 26-27 is 2000. So how much you can claim? 500 rupees. That is clear. 500 can be claimed. Now, can you claim 500 or can you claim 1500? Why that question comes? If you count the MAT credit on a year-on-year basis, 25% on year-on-year basis, it is 500, 500 and 500. So you can claim 1500 rupees. But in my view, that particular question has been floated in the professional world. In my view, the answer may be no. It clearly says that 25% of the tax payable on the income. What is 25% of the tax payable on the income of 26-27? That is 500. So you can claim 500 and not 1500. That is point number 1. Second point, which is little technical point, it says that the provision of this subsection shall be applicable only to an assessee being a domestic company that has exercised option under 205 or 115 BAA, whatever is the case. Then it goes on to say that where any amount of credit in respect of tax paid was allowed to be carried forward to the assessee under the provision of 115 JAA as on 31st March 2026. It says MAT credit, which is there, carried forward as on 31st March 26. Now we have an age-old concept which suggests that in case of a tax, your business results are determined from 1st April to 31st March. And when do you determine that tax result of your year? You determine not on 31st March, you determine on 1st of April. That's why all the cases which are being decided suggest that tax law applicable as on the first day of the assessment year shall be applicable throughout the assessment year. Now, is there a miss under the provision? Because it reads as beginning the tax credit which is there is accumulated as on 31st March 26. The question arises is that for the year 25-26 which is there, do you compute your MAT credit as on 31st March 26 or you compute on 1st April 26? Going by absolute technicality, it is on 1st April when you compute. But this particular reading seems to be a hyper-technical reading of the law. The department is of the belief, if you see the FAQ which came with the finance bill, it says that MAT credit accumulated up to 25-26. So in view of department, it is unlikely to challenge that MAT credit generated for FY 25-26 shall also be available to be carried forward for subsequent years, and hyper-technical reading may not be gone into. Last issue which I want to cover is that a particular taxpayer has not gone under 115BAA regime at all for years to come. Let's say up to FY 29-30, it has not gone. Now, from which day this particular period of 15 years would start? Does it start from the day on which I exercise the option, or does it start from FY 25-26 where the regime changes, or does it start from the date on which the MAT credit was generated? I'll leave that with you. Thank you so much for your patient attention. Thank you so much.
Thank you, sir, for such a wonderful presentation. Any questions? I think there are no questions. I request Sandeep Shah to propose a bill deserve vote of thanks.
Members, please request to wait for 2 minutes, sir. Just request everybody. On behalf of the WIRC and Borivali Central Study Circle, I sincerely thank CS Mehta for his time and accepting our invitation at very short notice. Sir, you have clearly explained along with the case studies, the tax provisions of the concessional tax provisions under the section 115BAA of the Income Tax Act and controversies around it. You also explained the MAT amendments by the Finance Act 2026. Your fluency and the command over the subject along with the well-structured comparative presentations made the session easy and highly effective. We truly appreciate your time, effort and valuable contribution. With this, I request all the members to extend a hearty vote of thanks to our speaker, Sri Mehta. Thank you. We'll just break for the 15 minutes before the second session.